right, good evening, guys. My name is Chubi Daniels. I'm a civil engineer by profession, real estate developer. So I learned how to buy properties, add value to them, and sell them. Then I am actually an investor, business analyst, if you want to put it in the right way. So I have my group. The group I have is just my group where we share books, we discuss intellectually. Then there is a group I actually coordinate. It's called the Fundamental Analyst Group. This place is where we fundamentally analyze assets to actually check whether they are good for the wrong time, so we know whether we can hold them. But to the topic of the day. So last time I came to discuss with this group, I was actually discussing something called moonshot investing. But from the questions I got, I realized that a lot has not been done. Like a lot of people don't even know how to invest or what to invest in. So today we'll be looking at how to invest in stocks from the Nigerian perspective. If you're Nigerian and you're looking to invest in stocks, what are you supposed to do and what you're not supposed to do? So I have a little presentation. Why are you supposed to invest in stocks? That's the first question. The first question is why. If you understand the why, you can actually endure anything. It says if you know your why, you can endure anyhow. That means no matter what comes through, you can actually endure it. So there are two main reasons why people actually want to invest in the stock market. Why do you want to invest in the stock market? Two main reasons. And the two main reasons why you want to invest in the stock market is because you want to understand the world. Now you want to understand that the stock market is actually a place where companies of the world are actually there. So all the companies in the world, from Google to Facebook to YouTube and every other company that produces one thing or the other that we make use of, are actually there on the stock market. So investing in the stock market will actually help you to understand how the world is being serviced by people, because when you have these assets, you have people that are servicing it. You can actually take advantage, understand how these things function. That is one thing you can do when you invest in stocks. The other thing you can do is actually just get finance. Like you want to increase your earning potential, you want to make money, you don't want all those long stories, you want to make money from the stock market. That can be another reason. So most people that invest in the stock market invest for two main reasons. They want to use it as a way to understand what is going on in the world, and then financial gains. Please, I want everybody on the chat to take note of this, because we will definitely come back to this. So if you understand why you want to invest in the stock market, then you can start asking the question, what is stock market? Does it mean a share of the company and all that? The first thing you must understand is why. Do I just want to increase my gain? Do I want to get knowledge? Why should I invest? That's why. Get your why first, then you are ready. Then the next thing you want to actually understand is where to start investing in stocks. A lot of people make the mistake of thinking, okay, I'm ready to invest in stocks, and then they say, okay, what kind of stocks am I buying and all that? No. There's something called platform risk. You want to understand the platform in which you can use to invest in these stocks, because that will determine the kind of stocks you can get. That can even help you shape your buying and selling strategy. It can help you for every other thing. If you get a broker which is like an application for buying your stocks, and this broker is actually not friendly with trading, and you're trying to use it to trade, it's going to affect you. There are some brokers that are not good for long-term investing. If you are trying to keep your stock for some time, they start penalizing you for actually keeping those stocks for some time. So that's actually a bad one too. So after getting why you want to invest in stocks, the next thing you want to understand is where to start investing. In Nigeria, currently we have some apps. We have a Trove, we have RiseVest, we have Bamboo and Chaka. Then we have passfolio too. So these are some of the apps we have on the Nigeria for people that want to invest. Funny thing about this, all of them are still using one broker. The broker is actually called DriveWealth. Now, before you actually go to invest, we want to actually enter, because all these things have their own community. You want to enter these communities. You want to learn about the community. You want to learn about the customer service. You want to actually find out if when you actually dial up the customer service, or when you send them a message, how quick they reply. Because one thing you want to understand first is your money is the thing that's going to be involved in this thing. So you don't want a place where you send them a message, my money is not there, and then it takes maybe 3 days before they reply you about your money. So first thing is getting your why you are supposed to invest in. After why you are supposed to invest, the next thing is getting your where. Where are you going to invest? You want to understand the platform. There is something called platform risk. Platform risk is the risk that exists that shows that maybe they are going to take away your money or something can happen. We know something happened in Nigeria recently where the Central Bank of Nigeria actually seized some of the assets of these platforms. So you want to understand where is the headquarters of this platform. I remember one woman, he always told me he couldn't use one foreign app. I was like, why? He told me that he can't actually walk to their head office in case they start misbehaving. So you want to know if you're that kind of woman that whenever they are misbehaving you with your money, you want to actually go there and knock at their office and then they will respond to you. So you want to make sure you understand where these guys are, understand which platform you're using before you actually invest. So the next question is, how much are you supposed to invest? Because after you have actually determined why you are supposed to invest and where you are investing, the next question is, how much should you invest? Now, one thing you should understand that investing is about the money that you are not using at the moment. Now, most times when I talk to people, I oversimplify the act of investing in the stock market. I tell them it's just like when you pick your money, you see the money you're not using at the moment. You go and meet a manager of a particular company. You say, Mr. Let's use Tim Cook for an example. He's actually CEO of Apple. You say, Mr. Tim Cook, I have this 30,000 naira. I'm not using it at the moment. Please take it. Use it and grow your company. And then finally, after some time, you give me back. So, understanding that you're giving these guys money, you don't want to give these guys the money that you need tomorrow. Understand you're giving Tim Cook, you're using Tim Cook as an example now. So, you don't want to actually stay in Nigeria and go and give your money to Tim Cook, and that is your child's school fees, and you'll be needing it tomorrow. So, if he just comes back tomorrow and say, Tim Cook, give back my money, that money may not really be available for you. So, how much you are supposed to invest depends on your finances. You are supposed to make sure you have emergency funds, like you have funds that are saved for emergency. You take care of your needs. Is your spare cash is the money that you are supposed to use to invest. Then out of that spare cash, how much you are supposed to be investing at any moment determines on something called strategy. Determines on the strategy you want to invest in the market. Determines on like how are you trying to approach the market. You're actually supposed to use your spare cash, not the amount you are willing to use. I refuse to take that narrative. I hear a lot of people say, invest the amount you are willing to lose. No, don't be willing to lose any money. We are in Nigeria. The economic condition is not good enough for us to even be willing to lose any money. It doesn't mean you shouldn't lose, but don't be willing to lose. Then, after that, make sure that the money you are investing is not money you need at the moment. There's a simple check I always use. Make sure the money you are not even using it in 3 years' time. Make sure the money you are not using it in 5 years' time. It should be something like 5 years, 10 years. That's when you'll be needing the money. Any money you are needing in 6 months' time, any money you're needing in 1 year time, you're needing in 2 years time. So some of those cash are the cash you are not supposed to put into the market. There's this narrative where people come to investment platform communities. They'll tell you something like, I have this money, I want to invest this now. I even had one that came to me. He told me that this is the money that he's planning to open a shop with it, I think in 3 or 4 months' time. But he wants to invest it into the market and make money. That is a mistake. You don't actually put that kind of money into the stock market. You spare cash into the market. So based on how much you use on the spare cash, that's a strategy, and we're going to discuss that in a moment. So that just brings the next question. What is the next thing you're supposed to do? You're supposed to have an investing strategy. There's a lot of people that think, okay, they just come into the market, they hear Mr. A saying, buy your stocks now, and then when there's 1% gain, you sell it immediately. They take that, they start doing it. And then they hear Mr. B telling them, don't sell your stocks, keep them forever. They follow that strategy. They meet Mr. C that's telling them to buy one stock at a time, buy little by little. They follow that strategy. They just keep running around, and that is the way to fail in the stock market. You can actually have multiple strategies, and that is just a recipe for failure. You want to get one strategy and stick to it. You have to get one strategy and stick to it. Most of the strategies you see for the stock market is actually good. All of them don't actually bear fruit at the same time, but all of them are good. You want to get one particular strategy, then focus on it. So this thing, there's this thing to say that even a dead clock is actually not wrong at all the time. Twice in a day, dead clock is right. So the strategy you pick, even though it may not win multiple times, but it actually has the chances to win a lot. I call this the dead clock analogy. One thing I want you guys to imagine is if you have this dead clock, and it's supposed to be 2 times, right? 2 times in a day. But let's just imagine that you use your hand and you are turning the hands of the clock. What is the chances that this clock is going to be correct 2 times in a day? When you're continuously turning the hand of the clock, even though it's dead, you continuously turn it the other way around. There is no chance that it's going to be correct 2 times in a day. So you have to find a strategy and then stick to it. You have to find a strategy, stick to it. Now, the next thing you have to do is actually choose which investments are you going to make. Okay, before I go into the investments you're going to make, let me just go back a little bit and talk about a little bit about the strategies that there are in the market. There are 2 strategies. There's something called passive investing and active investing. Now, passive investing are those who actually say, we don't have all the time to actually look into companies. And remember the initial thing I told you about understanding how the world works and financial gains. So you can always be looking for those things when you're looking for your why. Then when it comes to investment strategy, you have passive and active. A lot of passive investors don't want to even understand how the world works. What they really want to do is just to make money. So what they do is they actually want to just put money in something that generates money. They don't have to look at it. They just continually put money into the market and go. Active investing is where you have to actually come from time to time, maybe quarterly, whenever there is an earnings report, you want to evaluate your stock and you want to buy more. Now, this brings me to the concept of ETFs. What is an ETF? ETF is exchange traded fund. Now, this is like when you want to take a fruit, they are telling you, no, don't take banana, don't take a range. Instead, let's give you a smoothie. They mix everything together for you. So, an ETF is like a collection of a lot of stocks. Now, there is risk involved in every stock, and there is reward. When you actually bring all these stuff together, you combine their risk and reward to make it look like it's not going to be so bad for the person. So somebody who is not interested in each of these individual companies one by one can actually just pick an ETF and then just keep putting money there and get financial gain without even struggling to understand each of these companies. Personally, I'm not a fan of ETFs, but it's actually a good place for every person that's starting in the market, because one thing about the stock market is not about making profit all the time. It's about surviving long enough. So as a new person coming into the market, you want to get something that is well diversified. Diversified means it actually touches a lot of areas, so that whenever there's something going up and down, there's volatility. Volatility, when things go up and down, the price of something goes up and down. It's called volatility. So you want something that when the volatility is there, it doesn't really affect you so much. So that is what an ETF does for you. That is what happens when you actually pick a number of stocks, put them together, and then they are being managed. That is passive investing. Active investing is actually when you become a stock picker. There are people called stock pickers. Stock pickers are the people that actually go and pick a company. You look at a company, you take the name of the company, you research about the company, you buy from the company, you evaluate, and you continue buying. These guys are not just interested in the getting money from the market. They're actually interested in knowing more about the company and all that. So now the key to actually last long in the market. I know a lot of people, because I always like to give you all the options. A lot of people will be like, I'm not interested in understanding what goes on with Apple, Tesla, and all those companies. I don't even care how the world works. I just want my money. Then passive investing is good for you, especially when you are a new person. You can buy an ETF, just continually put money in your dollar cost average. Dollar cost average is continually buying into the ETF, and you make your money. But there is this other set of people who are the stock pickers who want to be interested. Now, my recommendation, or what I normally advise people, is don't just be somebody that is interested in money. Anything you are doing, even if it's business or anything, and you focus only on the money, it always doesn't give you the whole idea. That's why I said I'm not a big fan of ETFs. I'm a fan of, even if you're going for an ETF, make sure you actually take time to actually behave like a stock picker and research each of those companies and understand how the world work with them. So I think that's where I will stop for investing strategy, passive and active investing. So there's a lot of other things that can come in with active and passive investing, because under passive investing, you can see the people that actually just buy ETFs. There are people that create a coffee can strategy. Under active investing, you have the people that actually trade and a lot of other things that come under there. But the summary is there's passive and active. So you have to decide if you have the time, you have the interest to actually actively look at the market every day, or you want to just be a passive investor that's continually dollar cost average into a collection of stocks, and then you get your money, even if it's 5 to 10% at the end of the year, and you are cool with it. So let's go on to the next. So the next question is how to choose which investment to make. That means, which kind of ETF am I picking? What kind of stocks? If I'm a stock picker, what kind of stocks am I picking? Now, one thing you want to understand is the choice of ETF or choice of stock that you have to make has to resonate with the kind of lifestyle you're living. I've seen a lot of times when you have people that work 9 to 5, they are very busy. They come and they tell you, I want to become a stock trader. I want to be trading. You don't even have time for that. So the type of investments you are going to choose depends on your strategy, and the size depends on the life you are living, the way you actually act. The best option we give to people is when you want to start into the market. Let's say you're a stock picker. I like stock pickers. And you are into, maybe, let's say, medical line. The first thing you want to choose an investment that's in the medical line, not because it's beneficial, but because this is where you understand. There's something called circle of competence. That's like where you really understand what is going on. After some time, when you continue investing in medical, you can actually grow your knowledge, grow your muscle for reading their financial statements, and you can invest in other things that are not in that line. But when you're starting up, you want to concentrate on the things you understand very much. Since you understand very much, that's where you want to concentrate on. So, how to choose? You have to go back and read, perform some form of analysis on the investment, and then know how to start investing. Whether you are going to do something called lump sum investment, or whether you are going to do dollar cost averaging. Lump sum investment is when you use all your money to buy something at once, hoping that whenever it has a short-term gain, or whenever the gain is actually coming out, you just sell and go. Dollar cost averaging is when you continue buying small. You continue buying from time to time. So you have to know the kind of stock you are buying to actually know the kind of strategy you are going to use and the kind of investments you are going to make. Okay. Then the next question is: are you supposed to give somebody your money or to invest for you? Are you supposed to like invest with your own? One thing I always tell people is make sure you're investing in your own name. Invest with your own name. There's always an advantage of investing with your own name. Your money can never get lost and all that. I'm a full fan of you getting a mentor at the beginning stage. But the one thing I disagree with is don't let not having a mentor tie you down. You don't really need a mentor. You need action. You don't need a mentor. You need action. That means instead of waiting for a mentor, you can actually pick a book and read. You can actually learn something and then start taking small steps. Because each step you take, okay, what am I doing wrong? When you ask questions and all that, you may not even really need a mentor. But a mentor is always necessary because a mentor is like an adult guiding who guide you along the way and all that. But whenever it comes to buying stocks, you don't want to give any person money to buy in their own name for you. Make sure that every asset you own when you're buying a stock, because a stock is an asset, it's supposed to come with your name. So make sure any stock you're buying comes with your own name. Okay, then stocks for beginners. What stock am I supposed to buy if I'm a beginner? You want to buy stocks that are relatively stable. Relatively stable stocks, like stocks that are not very volatile and every other thing. Because this is like a baby taking baby steps. You don't want to give the baby to run 100 miles an hour and all that. You want the baby to take baby steps. Baby step means you don't want the child to actually invest $1,000 today and then he comes back tomorrow and discover that $1,000 is now $10 left. You want a place that even volatility is going to affect this guy's stocks. You put 1,000 to buy a particular stock. It's not really a volatile stock. Even if there's something shaking the market, you come back, you're seeing something like 900. And then even if it's going up, you come back, you're seeing something like $1,100. So you want to begin with something that's relatively stable. The more you get mature, if you want to go for the more volatile ones, the more you read and understand the particular industry you're investing in, then you can actually do that. A lot of people mistake and say that if you don't take risk, you are going to not make money in the market. But that is a lie. You don't really always need to risk before you make money in the market. One popular saying I like so much is a popular saying by Jeff Bezos. He said a lot of people are trying to find something that's going to change tomorrow. Are we going to switch to electric vehicles? Are we going to, what is going to change so that they can invest in it and then make money from it? Yes, that can be paying. But what people make mistake of forgetting is something called the Lindy's theory. They forget that things that have not changed over the years, when you come around, you see that those things are still going to stay the same forever. And your chances of making money from those things that are staying, that are not changing, is even higher. So instead of actually when you are coming as a beginner into market to actually chase all those things that are risky, ask yourself, what is it that is, I understand very well that cannot change. One popular example I always give, I don't know if there's a company for that, is like I ask people, do you think that in 50 years time there will be people not riding bicycles? And you know the answer to that is no. So if there was a bicycle company, yeah, they may not be giving you profit like electric vehicles and all the movement and all that. But one thing you are sure that is in 50 years time, the bicycle company is likely not to be out of business because that is something that's not going to change. So if you're a beginner, you are likely more to go to the field you understand, go to the, not just the field you understand, buy things that are not really changing. Then when you understand the market very well, you can actually go for the things that are changing rapidly. Okay, I really want to go to the next thing. When are you supposed to sell? So when you are supposed to sell depends on why you bought. It goes back to why. Because if you understand the company, you understand if I bought for financial gain or because I want to understand how this thing works. There is a company you buy, you sell immediately, there is a 1% profit. You sell immediately, there is a 2% profit. I have a whole lot of charts. I have a full chart on why you're supposed to sell. Maybe I'll share that to the group email after this. But you are supposed to sell when your thesis has been reached. If your thesis is after 1%, you sell, then that is when you're supposed to sell. Why you bought the stock determines why you're supposed to sell. Let's say we are two people. You plant an orange and I plant a carrot. You don't see me harvesting my carrots and you say, "Oh, it's time to harvest the orange." No, because why your own portion is not the same thing with my own portion. So why you bought the stock determines when you are supposed to sell it, and your strategy is also part of the whole idea. Now, if you want to get a better understanding, as I said earlier, for the people that have not joined by then, there's a group I actually coordinate. It's called the Fundamental Analyst Group. So those group, we actually try to see businesses and understand and all that. You don't have to pay to join the group. You just have to write us a thesis. A thesis is like a financial explanation of why you pick a stock. So I can guide you on how to write it. Then you can join the group. Then apart from that, I do have my own Telegram channel where I share books you can read on investing, because as I said, you may not need a mentor, you may just need action. So it's necessary you maybe join my group to get those books, read them, and then you can find a way to actually invest in stock markets. Understand your why, stick to your why, then you can actually know how to sell when it's time to sell. So where to start investing in stocks? Where do you start? That's the next question. Where do you want to start investing? We have actually seen this before, but that's the next thing. After you've gotten all this information, you know how to start. Where do you actually start? Yeah, you want to start very little. Like, you want to start very little, take baby steps, and then when you're finally strong to work very well, you can actually take the bold steps. Take very little steps. When you're finally bold enough to work very well, you take the bold step. Don't be the person that comes into the market and start asking, what am I supposed to buy that will go 100? No. Just understand why you try to invest in stocks. Understand how the stock market works. After that, understand the platform that you're using. Because if you understand the platform, I see a lot of questions when I go some of the communities, and I'm like, how did you not know that this application behaves like this? And you actually put all your money. You had $3,000, you have $5,000. You put all those money into that application. You didn't even know it behaved like that. Shows you didn't do enough research. If there's something doing your own due diligence means doing a little research work. So make sure you understand that platform. After the platform, take something that is you have understanding of, really understand, something that's within your circle of competence, something you really understand. That company is where you really want to start. And even in that circle of competence, make sure that it's something that's not very volatile, something that you don't just come tomorrow and then you see your money disappear, because as a new person that's coming into the market, you may not have the muscle for that. So you want to invest in something that you really can understand over time. And then the last thing is yes, you can actually message me to join my own Telegram group. It's actually for books and knowledge. That's what we're discussing there. And I always talk about how to invest in the fundamental analyst group. So thank you very much. And I'll allow people, if you want to ask a question, you can raise your hand now. Let me stop sharing my screen. I'm just hoping everything was captured. Fejiro, did this actually get interrupted at any point in time?
No, not at all. The experience was fine and audible. So yeah.
All right. Yeah, thank you. I think I have 1, 2, 3, 4. We have a couple of people here. So if you want to ask a question on how to invest in stock or anything at all, you can just raise your hand and I'll mute your mic, and then we can actually have answer the question. Okay, I'm gonna give like a minute for that to see if anybody is going to raise their hand. If nobody raises their hand, I believe perfectly you understood everything. If you click on my profile, you can see the link to the group I'm talking about. That's my group. Allowed to speak. Group Liz, Smart Money. Good evening. How are you doing?
All right. Good evening.
Yeah, Smart Money. Good evening. Yeah, I can hear you loud and clear.
You've done a great job trying to put us through the basis of the investing and everything. But I do actually have a question, but I just like the way you simplify the difference between those that want to just come into the market and like just want to like run, like don't want to kind of learn how to crawl, walk. Then
all right, I have a question.
Okay. Fejiro has a question. Please shoot.
All right. So let's say we're investing in an industry, right? And we have 2 companies that are competitors. And then I invested in company A because I thought they had this a particular moat. And then digging more about their competition, which is company B, I found out that their moat is actually something that company B has among their features, or maybe as a moat as well. So let's say the major moat for company A, company B has the same moat. I don't think then it becomes a moat, but now I already have positions in company A. So do you recommend I sell my positions in company A and move over to company B? Investing in company A, I'm already done with some percentages, right? Like I'm this overall. Sell my position, cut my losses, and move out to company B, or do I hold on with company
A? Okay, I want to tell you a story. I want to tell you a story of the people that bought BlackBerry. Okay, you know about BlackBerry. You know the company, right?
Yes, very much.
Okay, let me tell you their thesis. A lot of people that bought BlackBerry, they said phones are going to be the next thing in the world in the next 20 years. In the next 20 years, phones are going to be the next thing. Okay, but even though that thesis is correct, is BlackBerry still a major player in that thesis?
No, they are
No.
not.
The answer is no. So, if you are an active investor, it's your job to actually verify your thesis from time to time to time to check if the thesis is correct, if the thesis is broken. It's not your job as a retail investor to try to stay and change anything. You leave, you find another place. So if you said, okay, this is my thesis, and then maybe the thesis for the industry and everything is still correct, but the company you're talking about doesn't have that market, doesn't have that place in that thesis. It's your job to leave and find a better company that actually has that. Then once the thesis is broken, whether you have profit or you don't have profit, it's your job to sell and leave. Once the thesis is broken, you leave. It's the job of the insiders and the high stakeholders to change a company when something is broken. But if your thesis, let's say part of the fundamentals is broken, what you I hope I answered your question.
Yes, yes, you did. Thank you very much.